Most of the gap between what individual investors earn and what the market returns over time isn't about picking the wrong stocks. It's about behavior. The mechanics of investing matter. The discipline matters more. Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is May the 9th, 2026. Last week, we explored leverage and margin, the power and peril of borrowed money. Today, we turn to a question that should sit underneath every conversation about leverage. What are the actual risks of owning equity in the first place? We know that risk and return are inseparable. You can't earn the long-term returns on equities without accepting the risks that come with them. Understanding those risks is the foundation for everything that comes next in this series: valuation, portfolio construction, and how to think about your own equity strategy. Now, we're going to talk about three categories of risk that dominate the experience of owning stock for the typical investor. They are, number one, firm-specific, or what's called idiosyncratic risk; number two, market risk; and number three, behavioral risks. Now, these aren't the only risks an equity investor faces. There are others, and we'll touch on liquidity risk in a moment. But these three explain most of what goes right and what goes wrong over a long investing life. Now, just a quick word on liquidity risk before we move on. We covered it from two angles earlier this year in our March 14th episode on the bid-ask spread, and the next week's episode, March 21st, on stock order types. For the kinds of stocks that most of you will own, which are large companies that trade actively on major exchanges, liquidity risk is real but is secondary. Those earlier episodes are a great place to revisit liquidity risk. Now, let's start with firm-specific risk. Firm-specific risk is the risk that something goes wrong with the particular company whose shares you hold. Management makes a strategic blunder, a competitor disrupts the business, an accounting scandal surfaces, a regulator changes the rules, and the stock that was supposed to be your retirement falls 80% in a quarter and never comes back. We told one version of this story in our February 14th episode on credit rating failures. Enron was an energy and trading company that hid massive losses through accounting fraud. When the fraud came to light in 2001, the stock collapsed and the company filed for bankruptcy. Investors who had trusted the company and the agencies rating its debt lost almost everything. Many older investors will remember Enron as the most famous example of this kind of failure, but the pattern is older and more common than we'd all like to think. This risk tends to dominate over short time frames. The reason your stock moves a few percentage points on a Tuesday is almost always something specific to that company: an earnings report, a product announcement, or a leadership change. Now, you might be thinking, but just yesterday my IBM shares fell 10% because the whole market fell 10%. Which one is it, Andy? Well, both factors are at work in every price move. What separates one stock's return from another's day to day is mostly that company-specific news we talked about. That's why on the same trading day, some stocks rise while others fall. But when the broad market itself moves sharply, that move overwhelms the company-level differences, and your IBM shares get pulled along with everything else. Over longer time frames, the broad market direction is what dominates your returns, regardless of which specific stocks you hold. Now, firm-specific risk has a close cousin that's worth naming. It's called concentration risk, or commonly known as industry risk. It's the same fundamental problem, but scaled up to a sector or an industry. If you hold one stock and the company fails, you're exposed. If you hold 10 stocks, but they're all in the same industry and that industry suffers a structural decline, you're exposed in the same way, just at a higher level. The employee whose 401k is loaded up in their employer's stock and the investor who put everything into one sector during a boom are running the same risk, just in different costumes. Diversification, owning a broader mix of companies across industries, is the answer to both, and we'll dig into how that works when we get into portfolio construction. Now, the second risk is market risk that we've already alluded to. Market risk is the risk that the broad stock market moves against you regardless of which specific companies you own. When the whole market falls, it tends to take well-run companies down alongside the poorly run ones. The 2008 financial crisis is the clearest recent example. The S&P 500 peaked in October of 2007, then fell roughly 57% over the next 17 months, bottoming in March of 2009. Companies with strong balance sheets and good management did not escape the carnage. The macro environment dominated. This matters because the natural defense against firm-specific risk, which is owning more than one stock, doesn't help you here. If the whole market is falling, owning 20 stocks instead of 2 doesn't save you. The lever for managing market risk is different. It's about your time horizon and how you spread your money across asset classes, stocks, bonds, cash, and others like alternative investments. The connection to make today is to our April 2025 episodes on risk tolerance. The longer your time horizon, the more market risk you can afford to carry because you have time to ride through declines and recoveries. Now, the third category of risk today is behavioral risk, and it doesn't show up on any chart, and it's the one that almost always does the most damage. Behavioral risk is the risk that you pose to yourself. It's the gap between the rational, dispassionate investor that finance theory imagines and the actual human being making decisions under stress. Back in our March 15th episode of last year, we covered cognitive biases, the mental shortcuts that every human brain takes whether we know it or not. 2 of those biases are particularly punishing for equity investors. The first is loss aversion. It's the tendency to feel the pain of a loss more sharply than the pleasure of an equivalent gain. Second is herd mentality. This is the pull to do what everyone else is doing, especially when fear or greed is running high. Put them together during a market sell-off, and the result is predictable. People sell at exactly the moment they should be holding. They lock in the loss, and then they painfully watch the recovery happen from the sidelines. 2 examples make the point at different speeds. In March of 2020, the S&P 500 fell 34% in about 5 weeks as the pandemic hit, the fastest bear market in history. The investor who sold near the bottom in March missed a recovery that brought the index back to its pre-crash peak by August of the same year, just 5 months later. The crash was fast, and the recovery was fast, and the cost of panic was paid quickly. Now, the 2008 decline tells the same story, but on a longer time horizon. The market fell over 17 months, not 5 weeks. The investor who sold in late 2008 or early 2009, exhausted by what felt like an endless decline, missed a recovery that took roughly 4 years from the trough to reach a new high. The decline was slow and the recovery was slow, but the cost of panic was paid all the same, just stretched over years instead of months. Now, what does this mean for you? Different risks call for different tools. Market risk is managed by your time horizon and by spreading your money across asset classes, not just stocks. Firm-specific risk is managed by holding a broader mix of companies so that no single failure can wreck you. And behavioral risk is managed by structure, automatic contributions, a written plan that you set up when you are calm, and the discipline to not doom scroll and incessantly check your account balance during a sell-off. Here's the summary, and it's one financial professionals have made for decades. Most of the gap between what individual investors earn and what the market returns over time isn't about picking the wrong stocks. It's about behavior. Selling near bottoms, buying near tops, abandoning a plan when the news gets loud. The mechanics of investing matter. The discipline matters more. Next week, we'll explore how investors think about whether a stock is reasonably priced, which is an introduction to stock valuation at a high level without diving into present value mathematics. Understanding price and value is the next piece of our puzzle. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public educational good with your friends, your family, your colleagues, and maybe a neighbor. The show was produced by Nick Temte, and we'll see you next time on Money Lessons.